Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business, what it does, how it makes money, and what makes it competitively distinct.
ConocoPhillips came into existence in 2002 through the merger of Conoco and Phillips Petroleum. A decade later, it separated its downstream refining operations into a separate company called Phillips 66, becoming a pure-play explorer and producer.
As the world's largest independent exploration and production company, ConocoPhillips operates across the Permian Basin, Eagle Ford, Bakken, Alaska, and international LNG assets in Australia and other regions.
The business is fundamentally about finding, extracting, and selling oil, natural gas, and LNG. Unlike an integrated energy company, ConocoPhillips doesn't operate refineries or gas stations. It focuses entirely on the upstream side.
The central financial discipline here is cost of supply. ConocoPhillips maintains a portfolio designed to generate returns at below $40 per barrel, which means the company stays profitable across a wide range of commodity environments.
That low-cost focus isn't just talk. During the 2015 and 2020 commodity downturns, ConocoPhillips methodically sold higher-cost assets, cut production costs, and emerged from each cycle with a stronger and leaner portfolio.
On capital returns, the company has committed to distributing more than 50% of operating cash flow back to shareholders each year through a combination of the base dividend, variable dividend payments, and share repurchases.
The 2021 acquisition of Concho Resources added a significant Permian Basin position and was structured to be immediately accretive to free cash flow per share, an example of the disciplined acquisition approach the company favors.
Free cash flow yield, normalized across a commodity cycle, runs in the 8 to 10% range, among the highest in the E&P peer group, and a reflection of the low-cost, high-return nature of the asset base.
ConocoPhillips also holds meaningful exposure to LNG, which provides a natural hedge against North American natural gas price volatility and gives the company access to global LNG pricing in key Asian and European markets.
The proved reserves base supports a reserves life index of about 13 years, a measure of how many years the company can sustain current production without adding new resources, indicating solid long-term inventory depth.
Ryan Lance has led ConocoPhillips as CEO since 2012, having joined the predecessor company in 1984. That four-decade tenure spans multiple commodity cycles and gives him a historical perspective few E&P leaders can match.
Under Lance, the company's strategy has been remarkably consistent. Invest only in assets that meet the return threshold, return excess capital to shareholders, and maintain a balance sheet strong enough to operate through downturns.
Peers in the independent E&P space include EOG Resources and Devon Energy. ConocoPhillips distinguishes itself through its greater scale, international diversification, and the explicit return of capital framework embedded in its investor guidance.
With operations in 13-plus countries and production capacity near 2 million barrels of oil equivalent per day, ConocoPhillips has the global reach to allocate capital to its highest return opportunities across the cycle.
That's the company chapter for ConocoPhillips. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
ConocoPhillips just dropped Q1 2026 earnings, and they crushed both lines. Revenue came in at $16.05 billion versus the $15.57 billion consensus estimate.
An adjusted EPS of $1.89 blew past the $1.62 estimate. That is a meaningful beat in an environment where revenue actually declined 6.1% year over year.
The story here is execution and balance sheet strength. CHOP delivered $2.0 billion in capital returns, despite softer commodity prices, with the strongest balance sheet in the entire E&P space.
Quick refresher for anyone new to the name. ConocoPhillips was formed in 2002 through the merger of Conoco and Phillips Petroleum, and today it is headquartered in Houston, Texas.
They operate across 13-plus countries with core positions in the Permian Basin, Eagle Ford, Bakken, Alaska, Qatar, and Norway. It is a genuinely global independent E&P platform.
The company completed its acquisition of Marathon Oil in 2024 for roughly $22 billion, which significantly expanded its lower 48 inventory and scale advantages.
Today, COP trades around $125 a share, with a market cap near $154 billion. By any measure, this is the leading independent E&P company globally.
At the helm is Ryan Lance, chairman and CEO since 2012. He is an engineer by training with a 40-year career at ConocoPhillips, and he is widely viewed as a disciplined capital allocator.
Lance personally led the Marathon Oil deal and has built his reputation on the low-cost supply thesis, basically only sanctioning barrels that work at the bottom of the cycle.
Now let's walk through the numbers. Revenue of $16.05 billion beat the $15.57 billion estimate, and adjusted EPS of $1.89 topped the $1.62 consensus.
Operating cash flow came in at $4.3 billion in the quarter, which funded both the capital program and the shareholder return framework with room to spare.
Production landed at 2.309 MMBO, which is below the 2.389 MMBO reported in the prior year quarter, mostly reflecting portfolio shifts and timing.
Importantly, full-year guidance was maintained at 2.295 to 2.325 MMBO. The capital program is held at $12.0 to $12.5 billion.
COP returned $2.0 billion to shareholders this quarter, including $1 billion in buybacks. The Northfield East LNG project in Qatar is now over 80% complete.
Alaska had a strong showing too. Earnings from Alaska were raised to $318 million, helped by Alaska North Slope premium pricing and ongoing Willow project momentum.
One curveball. Qatar was excluded from the Q2 guide on regional conflict uncertainty. Even so, the balance sheet is rock solid with a debt-to-capital ratio of 27%.
On the analyst side, the street is broadly constructive. 30 buy ratings, 3 holds, and just 1 sell, with an average price target of $140 per share.
Valuation is reasonable for the quality. Forward PE is 22.7 times, EV to EBITDA is 7.1 times, beta is a low 0.28.
Dividend yield sits at 2.7%, and management continues to lean on its VROC framework, which prioritizes return on capital alongside disciplined growth and shareholder returns.
Let us hit the bull case. The LNG export platform, anchored by Northfield East and Corpus Christi, is shifting gas revenue toward global netbacks rather than depressed domestic prices.
Permian well productivity is up 7 to 8% year over year, which is a real efficiency tailwind. Alaska adds ANS premium pricing plus the multi-year Willow growth project.
The capital return framework is peer-leading at 45% of cash from operations. Few E&Ps can sustainably commit that much back to shareholders through cycles.
And the Marathon Oil integration is adding more than 20 years of high-quality inventory. That deal looks better as the Permian and Bakken assets get folded into the COP machine.
Now the bear case. Revenue down 6.1% year-over-year reflects weak natural gas and NGL pricing, which clipped the top line despite solid operational performance.
Qatar being excluded from the Q2 guide is a real overhang. Production also stepped down to 2.309 versus 2.389 MMBOED last year.
Waha Basin gas remains trapped at suppressed pricing. Marathon integration still has execution risk to monitor, and the longer arc energy transition is a real secular headwind.
On peers, COP trades at 7.1 times EV to EBITDA. Chevron is 7.8, Exxon 9.5, EOG 6.8, Devon 4.2, Marathon 5.1.
That premium to Devon and Marathon is justified by the lowest cost resource base in large cap E&P, the strongest balance sheet, and the most comprehensive capital return framework.
Quick options and insider read. Put-call ratio is 0.72, with notable call sweep activity pre-earnings above the 130 strike. Stock pulled back post-print on Qatar.
Ryan Lance share sales were via a 10b5-1 plan, so not a directional signal. The company also executed $1 billion in buybacks during the first quarter.
Bottom line, ConocoPhillips is the lowest cost large cap E&P, and they generated $2 billion of capital returns despite clear commodity headwinds in the quarter.
LNG and Alaska are the multi-year growth vectors. Watch production guidance, LNG first cargo timing, and any Qatar de-escalation. Q1 proved the model holds at lower prices.
For us, SIOP remains the cleanest way to own scale, low-cost barrels, and a real shareholder return engine inside the energy complex. Execution into year-end is the next test.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.